Hi, my name is Jerry Yu, the Family Money Doctor. I want to thank you for watching this video. Today's topic is how the interest is calculated in Index Universal Life Insurance Policy. This is one that can sometimes be confusing for some consumers. My expectation for today is that after watching this video, you will have a better handle on the index crediting methods for your IUL policy. With that said, let's get started. Just to recap, IUL is a form of permanent cash value life insurance policy that you pay for with after-tax premium. The benefit of having IUL policy is that it provides a tax-free death benefit to your beneficiary. It has tax-deferred growth and tax-free access to cash value that you can use as you see fit. It's often used for large capital purchases, other investments, and most commonly, tax-free retirement supplement. Now back to our question for today, which is how does that cash value component grow? Remember, when you pay your premium, a portion of the premium goes towards the internal cost of the policy, and the rest of it goes into the accumulation value, which is your interest earning account. This is one of the most important values in your life insurance policy, as this is the gasoline that keeps the IUL engine running during your accumulation and distribution phases. Another very important factor to note is that IUL is a principal protected with a 0% floor, which means in a negative market, you will not see your account balance go down. Again, this is very important, so I will say that one more time. IUL is a principal protected and shield from negative stock market returns due to the 0% floor. See, I have recorded a video in YouTube specifically talking about the importance of this 0% floor protection. Now let's talk about the crediting period. Unlike the stock market where you buy, trade, and sell every day, an IUL is much more conservative and credited once annually. The most common form of crediting in IUL is annual point-to-point method, which you can see on the board behind me. Annual point-to-point indexing involves tracking the performance of a chosen index like the S&P 500 over a one-year period. In my example, 1 year ago, in October 2022, it was 38.59, and a year later, in October 2023, it was 41.55. On an annual point-to-point basis, that's a 7.7% growth. Therefore, your policy will be credited 7.7% interest. However, as the industry has evolved, so have crediting methods. Income's volatility control index. Okay, these are meant to diversify away from purely stock index options and reduce your chance of receiving a 0% credit. They are typically made up of a stock component and a bond component. As you can see in my graphic here, the index manager would typically balance the weight of the index between stock and bonds. The reason being is the relationship between the stocks and bonds is typically inverse. That means if the stocks are up, then bonds will typically flat or down, and vice versa. If the stock market is projected to go up, the manager will shift the weight to the stock. Then you'll be participate in the upside. Right? If they're projected to go down, then they will shift over to the bond side and stabilize. Again, the goal with these volatility control index option is to reduce the chance of getting that 0% return after 1 year. And finally, there's another option that has nothing to do with the market and is guaranteed for 1 year. And this option is fixed account. The fixed account has a set rate at the beginning of every policy year. And this rate is guaranteed to credit your policy that amount, no matter what the stock market or bond market does. However, the index rate is correlated to the interest rate environment. So at the time of this video, we are in a very high interest rate environment. The fixed account is paying a very healthy 5%. But 3 years ago, when the interests were lower, the fixed rate was around 3% and much less appealing. Again, the fixed rate is determined at the beginning of every policy year. So you can decide if you're happy with that rate and plan accordingly. Now to wrap it up, you need to take away a few things from this video. One, IUL is one of the best ways to access capital tax-free and generate tax-free retirement income. Two, IUL is principal protected from market risk no matter what the index option you choose. And finally, IUL has many different crediting methods that you can choose from year over year to help add that gasoline to your IUL engine. So thank you for watching today's video, and if you find this video is insightful, please click the subscribe and like button, and I will see you next time. Thank you.